The December interest rates hikes are going to crash the economy. It happened again, ladies and gentlemen. If you didn't get a chance to see the Federal Reserve meeting for December of 2022, you're going to want to go back and hit rewind and watch it. Now, I know that Jerome Powell and everybody that's affiliated with the Federal Reserve meetings is not the most hyped up, exciting meeting in the world. But in spite of that, there's some interesting information that just happened. And I don't know that it was a massive surprise. I knew that the Feds were going to increase our interest rates by half a basis point. And so by 0.5, we just increased our basis point once again. So down from 0.75, 3/4 of a basis point, down to half a basis point. And what that means is that interest rates will continue to go up, ladies and gentlemen. And as we see this, what's going to happen at the end of this video, I'm going to talk to you guys a little bit about investment strategies and how this works. Now, for those of you guys who have not had the fortunate opportunity of watching some of my YouTube and Facebook lives, that I have been talking about economic growth and how cap rates and valuations run in opposite sectors. And one of the big things that's happening right now is the leverage point of building new construction or buying value add properties. Okay. Which one is the most valued asset to do based on interest rates going up and the Federal Reserve raising interest rates once again? So once again, ladies and gentlemen, the Federal Reserve sat back and what they said is they said, look, until we get to normal, quote unquote, normal inflationary values, we're going to continue increasing interest rates. Okay. And so the Federal Reserve is going to continue to keep raising interest rates until we get to a normal 2% annual increase in inflation. And so for those of you guys who have been experiencing and taking advantage of the 12% annual inflationary numbers that have been happening, and all the way through COVID, we hit over 21% inflation. And so those are massive numbers in 2 years. So we're talking over 10% to 12% inflation annually over the last year and the year prior. So a total of in excess of 20% inflationary numbers. So Federal Reserve, rightfully so, is sitting back going, okay, we're going to continue raising interest rates until we get to this plateau and we fix economic growth. Now, I have a little dispute with them, only because I know that the Federal Reserve is run by our central banks. And when the central banks make money, they do so when they lend money. And if they're lending money at a higher rate, they're getting higher revenues in return. Now, the banks' bottom line, their books and their bottom line is stronger right now than they've been in history. And so when we look at like 2008, people are sitting back going, Jerome, do you think we have another 2008 in front of us? If they keep raising interest rates this high, is it going to tank the market? And the answer is it can, but we're in an entirely different place economically as a nation, our banks and financial institutions. Because remember, when Lehman Brothers collapsed in 2008, ladies and gentlemen, or actually in 2007, leading to 2008, but the recession actually started in early 2007. It's just that people were in denial in 2007 that the recession had hit. So they call it the recession, the economic crisis of 2008, which it wasn't. It was 2007 when all AGI, Lehman Brothers, everything collapsed in our financial sectors. Banks were frivolous with money. They were giving it away to decredit buyers with, they were going after mortgages with 560 credit scores and sometimes even lower, leveraging real estate at over 110% of its value with home equity lines of credit. Ladies and gentlemen, you can no longer do that. With the CFPB, okay? The CFPB was put together in 2009 as a sector to protect consumers like you and I from banking and financial institutions trying to give out too much money. Now, does that protect you or does that protect them? I think a little bit of both. But the CFPB is really to protect consumers against banking laws, okay, and making sure the banks have certain sectors and laws put together that are fair. Okay, that's supposedly the cause and reasoning of putting the CFPB together. Now, what happened in 2008 and what's happening right now is entirely different. They're not even running at all parallel to each other. Okay, now, with the exception of interest rates going up, there's really no comparison. In fact, if you look historically, ladies and gentlemen, at history, and if you look at real estate, most people contribute the decline in real estate to a recessionary market predicated on 2008. But if you look historically, real estate traditionally is not affected by recessionary markets. Okay. Now, they are affected with the increase of interest rates because less buyers, less consumers can buy if money's more expensive and the same product costs them more money on a monthly basis to actually purchase. Okay. So we're going to see this. Here's my prediction. I believe that over the next 3 months, we're going to see an increase by, I'd say, a quarter basis point. Okay. In January. So last month, we went up 3/4 basis points. December, half a basis point. I predict that in January, we're going to go up another quarter basis point. In February, we're going to go up a quarter basis point. And then in March, we're going to go up another quarter basis point. So over the course of the next 3 months, expect, ladies and gentlemen, they just stated today, in the Federal Reserve meeting, they stated today that they have no expectation of letting up on increasing interest rates as we move forward into 2023 until they see dramatic data. Okay, so go back and watch me. Dramatic data that shows that inflation is truly going down. They said that this is a massive thing to control, and they're trying to make sure that we're not in an unstable place with inflation, because then it affects consumers and consumers can't buy. So the way they fix consumers so that consumers can buy is by crashing them even more, because consumers right now, ladies and gentlemen, are conservative. I don't know how many of you guys watching hashtag self-employed are self-employed. And if you are, smash a comment button and put hashtag self-employed. And if you like the information we're giving you, smash that thumbs up button, subscribe to our YouTube channel for more information just like this. Now, look, if you're self-employed, ladies and gentlemen, you yourself are feeling the compression and everything that's going on. Let me give you guys a little bit of insight on our businesses right now and how this is affected economically. Now, we have companies, our real estate development companies. I'm going to share with you as we move into this video how you can position yourself as an investor in any market. Okay, so I'm going to give you 4 means: 2 on an up market and 2 on a down market. Right now, we're in a declining market, how you profit. And then I'm going to give you 2 ways on how we are profiting in an incline market. So as we sit in this down market and we start riding it up, you know where the teeter-totter effect goes, where you know how to invest correctly as things migrate and they move. Okay. What up, Anthony? How you doing, brother? And so let's talk about this a little bit. Okay. Let's talk a little bit about where we're moving and what type of asset classes and how you should be investing as we get into this market. Because what's happening right now, okay, so people are over leveraged, consumers are not spending. And for those of you guys that are self-employed, follow me here, because I know you guys have all felt it. Because here's just a little example. I'll give you guys straight up vulnerability of what we've seen. So we've lived this. This is our 3rd recession, okay? We lived the late 90s. We lived 2007, 8, 9, 10. I'm talking, we were indebted in the recession. And so anytime a slowdown in the market happens, our phones slow down in our office. Okay. Hands down. Marketing dollars get more expensive. Revenue on the residential sector. Okay. B to C. Okay. That's business to consumer. Business to consumer goes down. Okay. Revenue from B to C goes down. Now, B to B business, business to business, typically goes up for approximately 2 years. Now, ladies and gentlemen, we're 9 months into this, right? About approximately 9 months into this. So my prediction is that we're going to see, because typically commercial or B2B sales within a 2-year period, they start to decline. It usually takes historically 2 years for B2B or commercial real estate to start really showing its prevalence in the declining market. So we're 9 months into this, we're 1 year into this, and we're already starting to see the potential of the deraveling of commercial real estate, okay? Residential is already showing its presence, right? Increased interest rates. Consumers can't buy single-family residential homes. So because single-family residential homes are harder to purchase right now in the single-family home market, what's happening is prices are starting to slowly drop, okay? And as they drop, the financial opportunity for buying renovated properties and doing flips starts to become more viable. Now, if you've listened to anything I've ever said, I said, screw the fix and flips. And I'm not a big fix and flip person. I'm a ground up construction guy, because I'll tell you guys that there is way less variables in ground up construction. But with that said, if you're a buy and hold person, I'll tell you guys that this is going to be the market right now. It started already. You should not be paying retail for land. You should not be paying retail for land right now, ladies and gentlemen, if you're buying land and building houses. And you most definitely should not be paying retail for single-family homes. In spite of me having single-family homes that I've built, I know myself that I'm going to take a compression on them. But no one's feeling sorry for me, because on the average single-family home of $790,000 that we were selling, even if we sell them for $750,000, we're still making over $160,000 net profit on every home, or we were making over $200,000 on every home. Okay. No one's feeling sorry for us, but we are feeling that compression. It is true. It's alive and it's real. And the single family market is feeling it. Okay. Now I want to explain some stuff to you guys. Let's answer. Doing all right. Love the recording from Red 2022. Red 2022 was off the chain, bro. It was good. It was really good. For those of you guys who missed it, my deepest condolences for you, because you're dying without that information. You guys are going to go back and get it. Okay. So this will all make a lot more sense coming in from that stuff from Real Estate Domination. Getting ready to build my second house. Build it, bro. We're building multifamily. We're building houses. Millie, I don't know if you're in our program or not, but if you're not, you need to be, because I'll give you guys the sweet spot where there's profitability, how we're still taking it down. We got a big group coming out to the Land of Enchantment in January. We got about 40 people that are coming down, and they're going to be taking a look at a bunch of my projects. 3 days, we're going to devour it. 3 days. 3 days, we're going to devour it. I'm going to show you guys ongoing projects, stuff we're stabilizing, all kinds of cool stuff, commercial, residential, everything, stuff that I've done historically over the years. You guys are going to love it, for those people who get a chance to do it. Big Cheerio. What's up, Big Cheerio? 8.5% interest rates to refinance my investment properties. You're getting hosed, my friend. Don't pay that. We're paying that for construction money right now. We are paying that for construction money right now, but not stabilized assets. If you have an income, don't be getting hosed with 8.5% rates. You need to come in and work with us, man. Share with you guys some financial institutions, some of our affiliates, some of our affiliate vendors that actually will work with you. You know, you got a real asset. You should be getting hosed at 8.5%. Okay. We're getting hosed on our construction loans right now. So we're trying to move through these things streamlined, because they're not stabilized financially producing assets yet. You know, we're trying to get them there. So we're getting hosed on money, but you shouldn't be getting hosed on money, not on refinances for investment properties that are cash flowing, my friend. Not at all. Okay. So look, I promised you guys that I was going to talk to you guys a little bit about the residential, a little bit about the commercial, but how do you position yourself to win? How do you actually, like now in a down market, how do you position yourself to win? And how do you look at the market different? Like where is that turn? Where is that turn in the market where you start climbing back up in an inclining market and you sit back and you understand the variables to switch? Okay. Now here's the thing. People always go, Jerome, how do you continue to buy real estate no matter if it's a declining market or an inclining market? The only difference between you and I is that I've lived it, I've learned it, and now we need to teach it to you so you understand it, so you're living it and you learn it. Okay. Now, watch, listen to this, guys. If you don't know what a cap rate is the amount of money you make every single year. The percentage of money you make if you buy an asset, like let's say Big Cheerio buys his asset, okay? And if his asset, like if he's going to get a refinance at 8.5%, you better be getting an 8.5% cap rate, okay? Because the cap rate is the amount of money that you're actually making after you've paid all expenses. minus debt. That doesn't include debt service. Okay. And that's why cap rates and interest rates have to go parallel with each other. So listen, hear me out here, because this is the key component to twisting on how you underwrite deals right here. Okay. Between the two markets. So when you go in, and if you have a higher interest rate, cap rates have to go up. Now, there's pros and cons to that. Okay. Now, most people sit back and go, oh my God, cap rates are going up. The only reason the cap rates are bad when they go up is because you either bought with too low of a cap rate prior. So now you're getting hosed and you can't refinance. Because if you have a 5% cap rate, 3% cap rate, 4% cap rate, or anything lower than what the banks are willing to lend you on that money, if you refinance and you get a higher interest rate, your cap rates have to run parallel with it, because otherwise you don't have the revenue to afford the debt on the asset. Okay. So if you're only making 5% cap rate, 5% on your money that's invested when you pay cash for the entire asset, and you're going out, and 80% of that, which most banks aren't lending, by the way, right now, it's typically about 70 to 75% with great credit right now on loan to value. Okay, or loan to cost, the cost to build, or loan to value on established assets. If banks are willing to lend between 70, 75%. Most of them, unless you're a really high valued customer, right now will only lend you between 70, 75, unless you're a high value customer. Maybe they'll give you 80% LTV, okay, loan to value. So what that means is that 80% of the value of that property is getting financed by the institution. So if you're paying that debt on 80% of your asset, that means that you're cash flowing on the 20% at a 5% cap rate. But if you're paying 7% for your money and you have 5%, you have a 5% cap rate and you have a 7% interest rate, that means you're paying 2% above your cap rate to just service the debt on that asset. So big cheerio, I'm telling you, bro, if your cap rate is lower than 8.5%, be extremely careful, because I would hate to see you go bankrupt on that property, or what my wife and I call trash can money. Every month, just throwing money in the trash, servicing debt. That's where you lose. So if you prevent that by knowing, now you have knowing knowledge. Look, ladies and gentlemen, if you guys like this information, pound that thumbs up button, man. Give me a little love. If you guys are learning anything right now, give me a little love. Pound that click and subscribe to our YouTube channel if you haven't already. Okay. Now, look, guys, in a market, when you guys go in, okay, when you guys go into a market just like this, and that's on a declining market, your cap rates and interest rates go up, your cap rate has to also go up. Now, what happens though is the value of that property goes down. Okay. Now, why is that important to know? Most people sit back and they're going, shoot, if cap rates go up. See, if cap rates go up, you make more money month after month because your percentage goes up. And the money that you're making month after month is also servicing the debt, but also on the part that you don't have debt on, the other 25 to 30% that you could retain your equity in, you're making more cash flow every month. So your cash flow goes up. Okay. So when you're underwriting deals, you have to underwrite them with a higher cap rate, which means you get more money every single month. Only problem is that with increased cap rates, the values drop. Okay, so when you're underwriting deals, now, ladies and gentlemen, you have to understand that if you're buying right now, you have to underwrite what you're buying with higher cap rates. And if the seller goes, I can't sell for that because I have to sell at a 5 cap because that's why I have it financed and the value's at a 7 cap, I'm going to have to give up all my equity. And so you know what this is? It's a violin that you're playing for them. Because who cares? They should have been smart enough not to buy. If you're going to buy, the only ones that lose in a decline market is those who can't hold their assets, ladies and gentlemen. So we knew this was coming. If the writing wasn't on the wall in 2018, 19, 20, and 21 that the market was going to decline, ladies and gentlemen, if the writing wasn't on the wall, what wall were you looking at? Your head must have been in a toilet bowl someplace, because I'll tell you guys, the writing was everywhere. If you guys went back to Real Estate Domination 2019, the first thing I said when I got in front of the room is I talked about this. Told people this was coming. And because the market was so high, cap rates were getting so compressed, we only had one way to go. You can't compress cap rates to zero. I mean, you can, but you can't service debt like that. So you're not gonna compress them all the way down to zero. We were like sub 3% cap rates. So when you bought a year ago, everybody sits back and goes, oh, I'm going to buy in his high market. His market's great. I'm going to keep getting rich, and value's going to keep getting going up and going up and going up. That's your first alarm that you sit back and go, whoa, man, values are going way too high. Where is the plateau to this, right? That's where new construction comes in. That's why I've been so heavy on new construction, because I'd sit back and I could control my equity. I could control my cap rate. I could control my values, because I can go in, and what we're doing now in new construction is now we have to be extremely careful. Okay. So for those of you guys who are watching this, listen to this. Okay. So people are sitting back going, Jerome, should I build or should I buy? Should I build or should I buy? Is the market going to get crashed with all of these interest rates going up? It's going to get crashed for some people, but it doesn't have to crash for you. Okay. It doesn't have to crash for you. And so like tomorrow, take for example, I'm sitting here in a hotel room. I'm down here in downtown Dallas. And tomorrow morning, 8:30, I have a meeting with the city of Fort Worth. And we have a potentially, quote unquote, $80 million project that now is probably only going to be valued at maybe $65 million. But that's okay. We're okay with that. But now we have to figure out how to get money from the banks and build this asset at a price that makes sense financially, with compression in rental rates slightly, and an increase in cap rates and an increase in interest rates. Okay, so it means that compresses now our values. Cap rates aren't getting compressed anymore. Values are getting compressed. So if values get compressed and they're lending money now, instead of an 80% loan to cost or 80% loan to value, and now you're going to a bank and you have a compressed value, you have to come to the table with more money to build the same asset class that we were once building just a year ago. Okay, so now we have to be careful on how we build. So one of the big things that we do right now is we sit back and we're compressing the way we're building. Okay, we were going to go ahead and go 4 stories. Now we go, nope, back down to 3 stories. But then I got on the phone with my architect and my engineer in Phoenix 2 days ago. And when we sat down with them, I said, can I build this asset 4 stories high so I can increase the density, so I have more money, right? Larger density, more clients, more customers, more rental units, more revenue. Increasing value, right? So I'm increasing the value by going bigger, not smaller. Most people think that if you go small, it's safer. There's safety in numbers. Okay. The numbers, duplication, compounding numbers. So we build more dense, increased units, larger revenue, and we increase our cash flow and our net operating income. Now, when we do this, how do we build it? So I'm in line. I'm in tune with my architects and my structural engineers right now, right? I'm pedaling in tune with them. We're in sequence. We're in harmony, okay, like a well-oiled machine. And we're talking, and we're communicating, and we're saying cost effective, cost effective, cost effective. How do we build this? So we came out to Dallas. We have another project in Fort Worth, and this project is a big project. We've been working on it since May. Okay. Now the market was slightly different in May than it is right now. So we were willing to pay at the time $4.1 million for this land to build 222 units of multifamily. And then we went in and we found out that there was some variables that didn't exist that the sellers told us they did. So we were able to bring the land down from 4.1 million to 2.25 million. That's a big number. That's just shy of $2 million discount on the same piece of land that we were looking at buying back in May. So we saved almost $2 million since May because of how we underwrite stuff and how we're doing our due diligence. So then we go to the city. Now we sat back and we're getting data. We're getting comps on what rental rates are and everything that's happening right now. We all know the writing's on the wall. The feds don't need to tell us. The feds don't need to sit back and tell us that interest rates are going to crash the market. If the interest rates keep going up, money becomes more expensive. Buyers, consumers become more restrictive on what they can buy, how much they can pay in rent, how much they can pay for at the gallon for gasoline, how much they can pay for commodities in grocery stores. Now, if you look at the data over the last 2 months, actually commodities and the cost of goods have actually went down a little bit, but just not enough for the feds. That's why they're saying, well, we'll give you guys a little bit. We're not going to go up 3/4 basis point. We'll go up 0.5 basis point because we're getting better, but we're not quite there yet. We're going to continue going up on interest rates just to make sure that the economy truly is stable. Okay. That's what their take on it is. And so what's happening is when we go in and we do this, now tomorrow we're going in and we presented these comps to the seller and to the broker. And we sat back and they don't even know what's going to hit them tomorrow. We go in, we sit down with the city tomorrow morning. Then right after we sit down with the city, we go and we sit down with our architect. And we're going to talk to our architect and say, hey, we need to build this simple. We want to make sure we can build this as simple as we want to build it with the city, but we need to make it look beautiful, like it's an expensive asset in the area that we're building, so the city feels warm and fuzzy about it because it feels economically friendly to the new growth and redevelopment, but yet cost effective to build. And so when we do this, then we meet with our architect right after it. And our architect's going to be a part of that meeting. Now we have new comps. So we're building a simpler product with lower rent rates because they have to match the comps, because the comps are different than they were just a few months ago. They've declined by $200. And so if you guys haven't already, you guys need to go back to YouTube. I'm going to put a video at the end of this where you guys can watch how cap rates compress values. Increase cap rates, compress values. Increase values, compress cap rates. Okay. And I did a full video on it this past weekend. I'm posting it on YouTube. I'm going to put it at the end of this video so that you guys can click and watch that. So you guys get a better understanding of what my brain's thinking. So you guys sit back and go, ding, ding, light bulbs, pound that smash and subscribe button and that thumbs up button. And you guys sit back and go, yes, mad value, Jerome, because you guys will understand how when interest rates go up, cap rates go up. When cap rates go up, values go down. So if values go down, that means hence the banks lend us less money. So we have to build a more cost-effective asset. And so now we go back to the seller, because that's who our third meeting is with tomorrow, on the land with the broker and the seller. So we go city first tomorrow, architect second, game plan, third meeting, broker, selling broker, and the seller himself is actually going to meet us on site. And they're sitting back all warm and fuzzy thinking, yeah, we're closing $2.255 million. We're going to be whistling Dixie to the bank, and we're going to slam them with a $1.6 million. We're going to slam with a $1.4 million offer on the renege of the purchase. And if we can get it for 1.6, ladies and gentlemen, that's over a $600,000 decrease from where we are right now. And it really makes sense at that number. So we're going to really push hard for that tomorrow. And so I will let you guys know how that goes. But because everything's getting compressed with interest rates right now and values are getting compressed, we have to be conservative. This is not a time to be paying retail, ladies and gentlemen. This is a time for you to leverage the whining speculations of the media, getting high ratings and viewings, trying to crush your limited beliefs and trying to crush your self-esteem, emotions, and all of everything you are to go out and buy and purchase. They want ratings, ladies and gentlemen. They're not looking for anything more than ratings and viewership. And people dwell on negativity. So I'm sitting back going on a negative outlook. Take advantage of it. Let them go out there and crash the market mentally for everybody. And let's go with our broom and our dustpan. Let's sweep up the pieces and let's profit from it. But the biggest way to do so is by knowing how. So we just go in with data. So tomorrow we go in with data. We're going to go in with data. We're going to go armed and say, look, these are real numbers. This is real data. Take it or leave it. Any sophisticated investor knows exactly what I'm telling them. And so they're only going to do exactly what we're doing. They're going to follow suit exactly like what we're doing. And they're going to have to be able to pick up this property at a discounted price right now. We're not paying retail. Let's answer a few of you guys' questions. David, with the market shift, my homes aren't selling. 90K profit 6 months ago versus same house plan can't get 30K profit. What would be the best way to survive the market shift? Well, I can tell you, if you're only making $90,000, it's because you're not building in the sweet spot. I have a feeling, David, that you are building in the median. You're probably building somewhere between $350,000 and $500,000 homes. It's what my presumption is. If you're making a $90,000 profit, and so if you're building between houses that are between $400,000 and $500,000, you're hitting the median. The average median home right now is between $380,000 and $450,000. Okay. So if you're hitting that, you're competing with the big builders. You're competing with D.R. Horton, Pulte, Lennar Homes, Toll Brothers, LGI. You're competing with all these guys. You're competing with these guys, with publicly traded institutional builders that are sitting back and they have volume. These are volume builders. So they'll lower their rates to shed inventory so that their bottom line looks good on their books. Okay. And in the process of doing that, as they're shedding inventory, guess what they're doing to your home values if you're competing against them? They're also shedding your values. They're slicing your revenue right there alone. That's why you're going down to $30,000. You're not in the sweet spot. Okay. Yes, the sweet spot is just above that. You got to be selling to more financially affluent people, not wealthy people, not $1 million homes, not secondary homes. That's the next market that gets hit after the base market. You need to be hitting the more affluent buyer. You need to be hitting the more affluent buyer. Our moms and dads, your grandmas and grandpa, people that have worked a 20, 30-year career, they have affluency in their life. They have a nest egg. And now they sell off an asset and they're buying something that's in the upper middle class, upper middle sector. Those people don't get hit as much by economic compressions. Interest rates don't affect them because a lot of them are buying cash. It's their second, third home. It's their final home, their retirement home. Okay. So that's why you're getting hit. That's why you're getting pounded. I'm with you, Millie. More info. Okay. I think that was, I would like more information. Okay. So that's a conversation between Millie and Big Cheerio. David, for reference, cost to build, $325. Market rent would be $2,300. Okay. Yeah, that's tight, man. That's tight. Those rents in that market. I'm not sure what market you're in. Let's see, Big Cheerio. Big love coming from Southeast Texas. I'm still shopping. I haven't pulled the trigger yet. Time to start pulling the trigger on some discounts. Big Cheerio. Anthony Russell, question: do you JV with your students or residential subdivisions in large multifamily builds? And if so, what do you want the partners to bring to the table? I want to bring value. I want value to the table, Anthony. There's so many ways to bring value. You got to get good at something. Okay, you can't bring nothing. Okay, so you either got to bring money to the table. Okay, that's one thing. That's one way you can bring value is by money. If you can't bring money to the table, that's okay. You got to bring value. You got to be able to know how to entitle land. If you can entitle land and you learn that. In fact, I have a land entitlement course that's coming out to help you guys because I want to teach you guys how to entitle land because there's a process to it. And if you guys entitle land, Anthony, I'll buy it from you and I'll be one of your customers, especially if you learn from me and you know how to entitle it correctly. I'll buy from you because there's a bunch of knuckleheads out there that think they know how to entitle land. They don't know how to entitle land. And then they go in just like these guys. Hopefully they're not watching this video before tomorrow because I'm calling them knuckleheads. But that's the reason we took them from 4.1 down to 2.2, and we're going to take them again down to 1.6 tomorrow. We're going to offer them 1.4, and they're going to cry all the way from here to Timbuktu. But I think we can get them down to closer to 1.6. And if we can get them down to 1.8, I'd be happy. But I really want to get them at 1.6. So we're going to negotiate hard tomorrow. But it's because they didn't entitle the land correctly. It's not entitled. Okay. And so there's a ton of mad revenue in entitling land. So I'll be dropping that course next week. It's going to be part of our Christmas sale. Get it for Christmas because it's less expensive. After Christmas, it's going to go way up. So anyways, we're gonna test it during Christmas. But I'll tell you, there's nothing to test. I know that once you guys see that, it's freaking gold. It's gold. Some of you guys will make millions of dollars utilizing that course without a lot of money in. So Anthony, one of the big things is you need to be able to bring value, money, contacts, real estate, like deals. You need to be able to entitle property, or maybe you're a builder, or and you're can GC it, and we can help you resume them. There's a ton of ways to come in, but yeah, we do partner, we do JV with our students and people that we work with. First time that we've ever offered that. Now after Real Estate Domination 2022 this year, we've been raising a lot of debt. We hadn't been giving up a lot of equity. I teach how to retain equity and alleviate having to give up, how to retain equity and how to just give debt on people's money, because you land up making a lot more money long term doing that. But students need an opportunity. So because we retain 100% of our equity in our deals and we don't give up a lot of them to investors, there's a method to it. We don't have to give up a lot of equity. Syndicators have to. If you're just syndicating deals, you have to give up equity. You got to, because people ain't going to invest in your deal. I don't have to. I can raise debt, especially with a jacked up economy like we have right now, where you can't make money in the stock market. All those stocks are up by 6% this month. FYI, hate Federal Reserve. Boop. news alert, stocks are up by 6%. But in spite of that, stocks are still down, right? And bonds are down, stocks are down, mutual funds, IRAs, all that garbage down. So where do you park your money? If real estate's down, residential's down, where do you park your money? You park it with debt. We'll give you 12%, 10% on your money. So you'll park it in debt. So I don't have to give up equity. Okay. And so we teach that. But because we keep so much of our equity, 100% of it, and we don't give it up to other investors, now our students are going to be able to take advantage of some of that this year. So it's the first time we've ever done that. In order to keep growing and scaling, we're going to give up equity on JVs to our students this year, Anthony. So yes, the answer is yes to that. As someone who wants to get into development, do you think a construction management degree is worth it and getting your GC license? Well, definitely getting your GC license is. I'll tell you right now, Dean, that construction management degree, yeah, go get it. But I've had a lot of people that are owners reps and project managers, and they suck at it in the development world. They teach you how to be a manager on site. They don't teach you the full aspects of how to buy real estate. They don't teach you how to invest in it. They don't teach you how to underwrite it. They don't teach you how to sell it. They don't teach you how to stabilize it. They don't teach you what stabilizes. They don't teach you about cap rates, market compressions. They don't teach you anything about that, Dean. All they teach you how to do is construction management, what the process of managing people is. And they don't even really teach that because there's a lot of psychology in that. You're better off taking a psychology course on how to, you're better off reading the book, How to Win Friends and Influence People, and reading that 10 times and reading it every year after you've read it 10 times, reading it once a year, every year for the rest of your friggin' life. That, Dean, will teach you how to be a better construction manager than anything else. Okay. Taking an accounting degree, being able to be able to understand how to manage finances, how money works. Because when you know how your money works or how your money's working against you, you will become a great construction manager because you're going to push the shit out of people to get stuff done, knowing what it's costing you if they don't produce. Okay. So Dean, I mean, I guess just from my statement, you know how I feel about that, right? I just think that, yeah, I mean, there's a lot of good information. I'm not going to tell you not to, but I'm going to tell you there's a lot of missing information as well. Anthony, thanks, Jerome. I'm contact with Steven from your office. Cool. Steven's cool, man. You guys know, like, I'll tell you, Anthony, Steven's not a sales dude. Steven actually started as a student. He was a real estate domination, 2019, 2020, 2021, 2022. He bought courses. He came in. Now, Steven, last month, working with us, just he's making over $250,000 a year working for us. And now he's actually has deals. He owns part of our apartment deal up in Rio Rancho. He's doing his own builds. He's entitled some land, flipped it. Dude, he's crushing it, man. So if you're dealing with Steven, that's working with us, he started just like you, Anthony, as a student. So anyways, ladies and gentlemen, what this was all about was letting you guys know whether interest rates increasing is going to crush the market. Don't let it crush the market for you. It's going to crush the market for some. Those who listen to mainstream media and don't understand what I just talked about in this video, you're going to get crushed. It's going to crush it for you. Don't be a victim of high interest rates. Embrace them, ladies and gentlemen. Embrace the high interest rates. The more interest rates go up, the longer the opportunity to buy is alive. As soon as interest rates start coming back down, ladies and gentlemen, the prices and values of real estate are going to start climbing right back up again. And so it's going to market you. So I'd rather have high interest rates and refinance, get it at a discounted price, buy my real estate discounted, refinance down the road, and just get great, sweet deals on real estate and hold them, get them cash flow, let them cash flow for you, instead of buying them high and then being stuck. Buying high sucks, guys, because if you buy high, you're stuck. You have to own it forever. Okay, so we build and hold now. I'm getting old. I'm almost 50. So I build and I hold. I buy and I hold. The stuff I don't hold is because either it's a pain in the ass or it's just such a premium deal to sell that I just can't say no to it. And it's just a no-brainer. I'll be like, damn, we just got to sell. We just got so much equity in this bad boy, and we just got to sell it. Or we cash out, we refinance, and we still hold it. But the time is now, ladies and gentlemen. Embrace the high interest rates. High interest rates give you great opportunities to buy discounted real estate, because with increased interest rates, increases cap rates, more cash on cash return, more money every month, but values diminish. As interest rates go up, cap rates go up. As cap rates go up, values drop. When values drop, you buy. And then as interest rates drop, cap rates drop, and values go back up. And what you bought discounted, you ride back up on the incline. Ladies and gentlemen, thank you guys for joining me late this Wednesday evening for Wednesday's Real Talk on Real Estate. God bless you guys. Go out and compound your success. And then remember, I'm going to put that other video that I recorded this past weekend in here. Click, watch, pound that thumbs up button if you like this information. Click and subscribe to our YouTube channel. You guys go out and make it a great day and compound your success.